left to cover on international. We have some powerful forces going on in the global markets, and it's called purchasing power parity. Now, imagine if, let's take Mexico since they're kind of our neighbor. What do you think's true about the price of, let's take something like a chair or furniture. Suppose we could use iPods or something. Let's take a gizmo. Let's take an iPad. How much does an iPad run? $600. So the price of an iPad is $600. Okay, so suppose that the price in Mexico. Suppose that the price in Mexico was effectively $100. You know, you've heard of, stuff down in Mexico is so cheap. Let's go to Mexico. There's lots of cheap stuff to buy, right? So let's just say that the price of an iPad in Mexico effectively ended up being $100. What do you think would go on, assuming that Americans and Mexicans, for that matter, but I guess let's just leave it at Americans. Americans are pretty free to go into Mexico and back over, right? They can travel back and forth. Not true vice versa, as we know. So if Americans are free to go back and forth, what would Americans tend to do? Some entrepreneurial Americans.
Buy a bunch of Mexican iPads and then sell them in the United States.
Yeah, right? We just go across the border, load them up into a big van, as many as we could pack in the van, as long as it's not illegal and, you know, we're not doing drugs and marijuana, bringing cocaine across the border. We're just bringing iPads. We would buy in this market, buy in the Mexican market, and resell in the American market. Then we just post them on Craigslist or eBay or whatever, and we make some money. So that is called arbitrage. So this brings up what we call arbitrage potential. What arbitrage is to simply buy in one market and resell in another without really adding any additional value other than you've relocated it. So perfect arbitrage, you wouldn't even have to do that, which people can do in the comfort of their home potentially. Secure the Mexican good and then have it shipped to an American address, right? They don't even have to leave their couch. There's not any cost whatsoever. That's what we get at with arbitrage, where there's no extra value added. You're simply buying in one market and sell in another. And I might have you just note, since I brought up entrepreneurship, it's not really the true entrepreneurial spirit of buy low, sell high. We're usually adding value. So entrepreneurs are usually adding value. So the key note here is that there's no value added to the good prior to resale. And that's what makes it arbitrage as opposed to just being, oh, that's a good idea, it's something profitable to do. But there's kind of a gray area there. Okay, so back to our story. If there was an arbitrage possibility, and in Mexico, they don't take dollars, or let's pretend they don't. In some areas, we know that they do take dollars if you've been to some of the tourist areas. But let's say they only deal in pesos. What must you then do before you buy the iPad. You got to convert your currency. So if we take a look at what's going on in the currency market, and let's go ahead and use dollars in foreign exchange. Are people demanding dollars or demanding pesos? Demanding pesos. So the demand for dollars would start to fall. The supply of dollars, people would be dumping dollars. So both those supply and demand forces would be an increase in supply, a decrease in demand, leading to dollar depreciation from E1 to E2. All right, so the point with this is that if there's arbitrage opportunities, the exchange rate will start to kind of sop up that difference. And when we start to have the exchange rate changing because of the behavior, we're going to see these things two converge on each other. Because there's really, at the end of the day, other than we talked about maybe some transportation costs, no reason that the iPad across the border shouldn't be effectively 600 when we convert the currencies. And that's exactly where things will gravitate to in equilibrium. And so that concept we call purchasing power parity. Purchasing power parity. And it's an important concept we see going on in international trade. There is an interesting index that I encourage you to check out on your own. I can't remember if your textbook brings this up or not, on the Big Mac. The McDonald's Big Mac, where is that sold besides the United States? Everywhere, right? McDonald's has been able to successfully put their product around the world. And I'm not finding my, well, that's right. They have successfully put the Big Mac in China, in Finland, in India now. It might go by a different name, but it's basically the same thing. And so the key thing that the Big Mac has is one of McDonald's guiding principles. Well, you tell me, what do you think is a guiding principle for McDonald's? You go to California, you go to Kentucky, you go to Kansas, you go to New York. Within the United States, what's true about that Big Mac when you visit McDonald's no matter where you go? It's the same, right? Consistency. That was one of the things that Ray Kroc, one of the founders of McDonald's, prided on, was that we got to be able to deliver the exact same product. Down to the microscopic taste bud, we got to provide the exact same product to that person so that they have faith when they go to a New York McDonald's, it's going to taste the same as the California McDonald's. So we've got that identical product thing going here, right? So we can test what's causing the price difference of the Big Mac in China versus the Big Mac in California versus the Big Mac in Germany. And so there's literally a Big Mac index of purchasing power parity that starts to suggest what direction exchange rates might be changing due to changes in the Big Mac prices. And so you can map out, people actually follow this. It's published in The Economist, the publication called The Economist. It's regularly published for a large number of years. So you can Google on your own time sometime Big Mac index, and it's kind of interesting to look at how the Big Mac varies around the world. And so the guiding thing that drives those prices to be basically equal to each other after taking into account the exchange rate is purchasing power parity. PPP. purchasing power parity. I got one other thing on it. Another concept is interest rate parity. So purchasing power parity is identical goods in different countries identical goods in different countries will cost the same. So in theory, the exchange rate times the price of the Big Mac, the exchange rate times the price of a Big Mac is equal to the price of a Big Mac in a different country, P star. In other words, the real exchange rate, which we talked about, left off with last time, the real exchange rate is 1. One Big Mac gets traded for one Big Mac. They're the same thing. In concept, as long as they're not different Big Macs and they're the same quality, one Big Mac would be willing to be traded for one Big Mac. If you were two countries, Mexico and the United States, hey, do you want to trade? Well, those two things should be equal when we think about the real exchange going on. So the real exchange rate is equal to 1, which means one Big Mac equals one Big Mac. So how does that happen? The nominal exchange rate is going to adjust so that that occurs. So the key point is that in general, the nominal exchange rate will adjust so that the effective effective, I don't know what I did here, effective, that one might need a redo, so that the effective price of the good is the same. Your textbook goes over a couple nice examples on computer chips, like Intel chips, so that the effective good is the same, price of the good is the same, whether priced in dollars or yen or whatever other foreign currency we're looking at. A kissing cousin to purchasing power parity is interest rate parity. So imagine if we have a financial instrument, a bond, that we have two fairly similar governments that are strong, the US government and the German government, and we're looking at interest rates. After you take into account swapping currencies, then the effective interest rate should be the same for both of those financial instruments. So again, I call this a kissing cousin to it because instead of talking about Big Macs that have a price of $1, we're talking about a financial instrument that has a price of 4% interest, right? So the price of the financial asset is an interest rate. So it's really the same thing. The exchange rate will adjust so that financial assets of the same risk will yield the same expected rate of return. All right. So our last complicating factor to all this, if it's not complicated enough, is that the composition of goods at the economy level considers a whole bundle of goods. How many goods? Thousands, millions. We're talking about real GDP, the dollar value of all final goods and services produced within the nation's boundaries over the course of the year. So if we look at all the goods produced in China, all the goods produced in the United States, there's a number of different factors. And so at the end of the day, how exchange rates in the global market, because this little example I went through here is true, but that was only true with the iPad being influenced. Imagine that we got thousands of goods that are tugging and pulling and arbitrage and people trying to make money and some people losing money, right? So we have all those goods taken into account. And so in reality, at the micro level, we've got purchasing power parity and interest rate parity kind of playing on any particular one that you pick out of the basket. But in reality, each country has a large bundle of goods, GDP. And therefore, it's the average price of all those goods. We're going to tie this back to inflation and the price level. And therefore, the price level, PL and PL star, the price level in each country, the foreign country as well as the domestic country, is going to play a role in the determination of how much the yen sells for compared to the dollar, the yen versus the dollar, the peso versus the dollar. And therefore, the price level in each country is the important factor in determining the exchange rate. All right, so what does that look like? I kind of wanted to derive this from there, so let's just put in recall. I said that the price of the Big Mac equaled the price of the Big Mac in China. This expression, purchasing power parity, told us this, and that the real exchange rate is essentially 1. One good should be equally priced. if I take advantage of this equation the way we've got it written, then I can re-express this as the nominal exchange rate being equal to the real exchange rate times the price of the Big Mac. But now let me just insert in the price level. Just put an L instead of the BM. And the price level of the United States. So if the two countries have the same price level, the real exchange rate and the nominal exchange rate are one and the same. We're going to be trading 3 for 1, 1 for 1, whatever the case is between these two goods. Those two things will be equal. And the driver in the long run then is the price level. That's important as we bring the quantity theory of money back into play. We learned at the tail end of Chapter 8 that the central bank has an important role in determining the price level. In the long run, if it continues to ramp up the money supply by 8%, what would you expect inflation to be in that country? 8% in the long run. So we had that one-to-one connection there of money supply growth and price level growth. So in the long run, monetary policy drives inflation. And what that tells us in this equation is that if the United States continues to pump out money at 8%, this is going to continue to grow. If the foreign country stays the same, what happens to the U.S. value of the dollar? It goes, look at this equation. I want everybody to see it, not just the more mathematically minded people. So this is the United States. Remember, the star is the foreign country. The United States price level's in the denominator. As the Federal Reserve starts to pursue policy that's inflationary, this grows, making this expression fall, which means the nominal exchange rate's going to fall, which is depreciation. So there's the connection now between monetary policy and exchange rates. The actions of the central bank in each country is going to have an impact on what the currencies trade for. Okay, so let's write that up here. So recall quantity theory. And let's just put, most of you had this right on your test, percentage change in money, quantity of money leads to an equal percentage change in the price level. In the long run, underline that, in the long run, that was Milton Friedman's prediction. And now we see the connection to exchange rates. So let's just write it this way. If the rest of the world has an increase in the price level, so PL star gets bigger, that'll lead to the exchange rate getting bigger, which we learned from last lecture, previous lecture, that that's appreciation of the dollar. So this is appreciation. So you guys are going to have some multiple choice problems and some other things on your homework that are going to be worded such that suppose the foreign country starts pursuing inflationary stuff, or the price level in this country grows while the other one stays the same. What happens to the exchange rate or the value of their currency? So the dollar is going to appreciate, which then of course means depreciation of the foreign currency. What happens to one is just the opposite of the other. If the dollar appreciates, the foreign currency is depreciating. So we learned that last time too. So if the rest of the world has a or I'm sorry, I meant to say the U.S. in this case. If the U.S. has an increase in the price level, if we have inflation going on in the United States, holding the rest of the world constant, that'll cause depreciation of the dollar. Depreciation of the dollar. So we're now seeing the link of monetary policy globally. So the key point that brings this around to the forefront in international exchange is that in the long run, the exchange rate is, the nominal exchange rate is determined by the relative quantity of money in each country. That logic flows from what we just started here. I was saying increases in the price level, but I was coming back, or that statement ties back to what we learned here. Monetary policy is what causes changes in the price level, or the main driver of it in the first place. Okay, questions or comments on that? I know that one's a little thick. Worked through a few problems, but now we're starting to see how domestic policy in these countries does flow through to the rest of the world in exchange rates and causes there to be, that's the connection to the globe. In this global economy, 20 years ago when I was teaching this class, it wasn't maybe quite as important then as it is now, certainly not 40 years ago or 50 years ago when people were teaching economics, to worry as much about that. U.S. was king, it wasn't quite as a global economy as it is today. Now, when you guys go to work for whatever company you do, I bet a decent amount of money, I don't want to commit to anything, especially on camera here, but I would bet a decent amount of money that the company you go to work for, the company that you start, is going to do something globally somehow. You'll be impacted by having to change currency. You'll be buying it from a supplier in a different land. You might have a place over in India that's supplying part of your product, even if you primarily sell domestically, or you'll be selling some of your products. So whether it's in the supply chain or whether it's in the retail market, you're going to be dealing with the rest of the world. And we're all connected in this regard in the marketplace through these functions of supply and demand in the marketplace. All right, now, last thing we're going to cover in this chapter is the government's, I don't know if I should use the word rigging or fixing. Fixing is probably a pretty darn good word. Fixing the exchange rate market. So, it's possible for governments to maintain the interest rate at a fixed level. Now, maybe even from what we've done, you can see how they might do that. Let's go back to this example here. So, we were starting to buy foreign goods. The exchange rate was coming down. So maybe the exchange rate for the peso to the dollar was $1 per peso. I gotta be careful of that. We're doing 13 pesos, it's not dollars. So remember, this would be pesos per dollar. So we got 13 pesos per dollar, and it's now down to 10 pesos per dollar. Now, if the United States government said, for whatever reason, I want to keep the exchange rate at 13. market forces are driving it down, right? So let's pretend for a moment that the government wasn't involved at all in this. The private marketplace was driving the exchange rate down to 10. What could the government do to maintain it at 13? What would the government need to do? Remember back to our story, Americans are supplying dollars to the foreign exchange market, driving it down. What would the government need to do?
Decrease the money supply.
Decrease the money supply, demand more dollars. Okay, so the government could come in, and it could come in on the supply side or the demand side conceptually here, but they need to be kind of an answer to the market. If somebody wants to dump their dollars, the government could be the demander of them, right? So they could offset that. And so they could pursue policy. If the supply of dollars was coming this way, they could pursue policy to increase demand to keep it at 13. So, long story short, the government can enter the market and be the buyer or be the seller, be whoever they need to be on the other end of the market to keep that exchange rate fixed. All right, so the topic we're getting into is flexible versus fixed exchange rates. Exchange rate, the fancy word we'd use would be exchange rate regimes. Regimes meaning kind of decision made by the government. So government decision. We'll start with the flexible program because that's the one we've been working on. We just assume that the market is just kind of doing its own thing. So with the flexible, the government does not enter the market at all, directly anyway, to influence the exchange rate. So the flexible allows E, the nominal exchange rate, allows the nominal exchange rate to adjust freely without direct, and I want to use the word direct, sometimes they indirectly get in there, without direct intervention of the domestic government. Well, if we're talking about the United States, it'd be the United States. So it's basically a free market. So one of the countries that's in the main headlines in this regard is China. China has not been in the flexible business. They've been very rigid, very fixed. For a long period of time, the Chinese yuan was fixed at 8 yuan per dollar, an 8-to-1 ratio. So a fixed exchange rate regime, a fixed program, is such that the government chooses the nominal exchange rate and buys or sells currency to maintain the fixed rate. So, example, China, for a long period of time, maintained the exchange rate at 8 yuan, Y-U-A-N is the Chinese currency. 8 yuan equals 1 US dollar. Okay. So on the balance of payments, if you're right, remember we had the 3 accounts that you need to know for the final exam. We had the current account, the capital account, and the official settlements account. So each one of these governments has in their inventory currencies. And the Chinese government is the largest holder, I believe, of U.S. currency, the largest foreign holder of U.S. currency. Because what would have happened historically now over the last 30 years, as the United States starts to demand more Chinese goods, right? So imported from China, that little label that's on, seems like half the stuff at Walmart or more, right? As we started to demand Chinese goods, what should have happened is a change in the exchange rate, which would have, in the Chinese eyes, led to less exporting. And so they didn't want to do that. They wanted to keep the yuan cheap, keep those Americans coming back. Low price. You think Walmart has low prices, come to China, right? So we keep the Chinese yuan cheap, and the Americans kept coming. So they didn't allow the exchange rate to naturally adjust, and so that's why it's been kind of an issue lately. So President Obama and President Bush both started putting pressure on the Chinese government to allow the exchange rate to adjust. So it has come down, and I'm not sure what it's exactly at, but it's at 6 something now. 6 yuan equals 1 US dollar. They have changed that, and so there's kind of a hybrid of fixed and flexible that gets adopted called a crawling peg. A crawling peg is probably starting to be what the Chinese government is looking at more and more now. A crawling peg, in that there are periodic, not every day, not every week, but periodic adjustments to the exchange rate. You can see even what this happened over the last 10 years, this type of adjustment. 1 US dollar now only buys 6 yuan. Doesn't make the Chinese good quite as attractive, right? So the world would probably look a little bit differently today had China pursued a flexible exchange rate the last 30 years as opposed to a fixed exchange rate. All right, we will call it a day there. I did forget to announce